What if I told you there's a media company trading for less than $5 a share that's currently at the center of a potential multi-million-dollar acquisition? Today we're diving deep into Scripps Company, ticker symbol SSP, a stock that's been making headlines and catching the attention of investors looking for opportunities in the under $5 range. Whether you're a value investor searching for hidden gems or someone curious about what's happening in the broadcasting industry, this could be one of the most interesting stories you'll hear today. So stick around because by the end of this video, you'll understand exactly what's going on with this stock and why it matters. Let's start with the basics. The Scripps Company isn't some startup trying to disrupt the market. This is a legacy media enterprise with roots going all the way back to 1878. Yes, you heard that right, 1878. We're talking about a company that's been around for nearly 150 years. But what exactly does Scripps do today? They operate as a diversified media company through two main segments. First, there's their local media division, which includes more than 60 television stations across over 40 markets in the United States. These aren't just small stations in remote towns. We're talking about major network affiliates producing local news, sports, entertainment, and everything in between. Then there's their Scripps Network segment, which runs national television networks that you might actually recognize. They own ION, Bounce, Grit, Court TV, and Scripps News. If you've ever flipped through channels, you've probably landed on one of their networks without even realizing it. Now here's where things get really interesting. As of early December 2025, Scripps stock is trading around $4.30 per share. To put that in perspective, this stock has had a wild ride over the past year. The 52-week range shows it's bounced between a low of just $1.36 and a high of $4.91. That's an incredible amount of volatility, and it tells us that something significant has been happening behind the scenes. The company currently has a market capitalization of around $390 million, which in the world of publicly traded companies is actually quite small. For comparison, that's less than what some individual celebrities are worth. But small doesn't necessarily mean bad, and sometimes it's these smaller companies that present the biggest opportunities for growth. Let's talk about what happened recently that's been driving all the excitement around this stock. In late November 2025, broadcasting giant Sinclair made an unsolicited takeover bid for Scripps. Sinclair offered $7 per share, which would be split between $2.72 in cash and $4.28 in Sinclair stock. Now why is this significant? Because $7 per share represents a massive 200% premium over where the stock was trading just weeks before the announcement. When Sinclair first disclosed they had acquired an 8% stake in Scripps back in mid-November, the stock jumped 40% in a single day. That's the kind of movement that makes investors pay attention. Sinclair currently operates or provides services to 185 television stations across 85 markets. So combining with Scripps would create an even larger broadcasting powerhouse with over 240 stations nationwide. But here's the catch, and this is important. Scripps hasn't exactly welcomed this offer with open arms. The company issued a statement saying their board would carefully review the proposal, but they also made it clear they're prepared to protect themselves and their shareholders from what they called opportunistic actions. In fact, Scripps went as far as adopting a poison pill defense mechanism, which is basically a strategy that makes it harder for someone to acquire the company without board approval. This poison pill gets triggered if any investor crosses the 10% ownership threshold, and it would allow existing shareholders to buy more shares at a 50% discount, effectively diluting the acquirer's stake. Sinclair currently sits just under that line at 9.9% ownership, so they're right at the edge of triggering this defense. So why would Sinclair want to buy Scripps in the first place? The answer comes down to scale and survival in a rapidly changing media landscape. Traditional broadcast television has been under pressure for years as viewers increasingly cut the cord and move to streaming services. Companies like Netflix, Disney+, and YouTube have been eating into the audience that used to reliably tune into local TV stations. Sinclair believes that combining forces with Scripps would create synergies worth approximately $300 million. These synergies come from things like eliminating duplicate operations, negotiating better deals with advertisers and distributors, and spreading fixed costs across a larger revenue base. Sinclair's CEO has argued that greater scale is essential for broadcasters to compete effectively with big tech and big media players, while maintaining their role in producing local news and serving communities. But there's another angle to this story that's worth understanding. The Federal Communications Commission currently has rules limiting how many households a single broadcaster can reach. Right now that cap sits at 39% of U.S. households. A Sinclair-Scripps merger would likely bump up against these limits, meaning the deal would need regulatory approval and might require selling off some stations in certain markets. However, the regulatory environment could be shifting. Under the current administration, there's been talk about loosening these ownership restrictions, and the FCC chairman has expressed support for allowing more consolidation in the broadcasting industry. This means a deal that might have been difficult to get approved a few years ago could have a better shot now. Nexstar Media Group is already in the process of trying to close a $6.2 billion acquisition of another broadcaster called Tegna, and they've requested similar waivers of the ownership cap. So Sinclair and Scripps are watching closely to see how that plays out. Now let's get into the numbers and what they mean for potential investors. Looking at Scripps financials, the company reported revenue of about $2.32 billion over the trailing 12 months. However, profitability has been a challenge. The company shows a net loss of about $39.65 million, which translates to negative earnings per share. The stock currently trades at a price-to-sales ratio of just 0.17, meaning investors are valuing the entire company at less than 20% of its annual revenue. That's remarkably low and suggests either the market thinks there are serious problems ahead or there's a potential value opportunity here. The company also carries significant debt with a debt-to-equity ratio over 200%, which is something any investor needs to consider carefully. High debt can amplify returns when things go well, but it also increases risk when business conditions deteriorate. Analysts who cover the stock have mixed opinions. Based on recent analyst ratings, 2 analysts recommend buying the stock while one suggests selling, leading to an overall neutral rating. The average 12-month price target among analysts is around $5.50, with estimates ranging from a low of $1.50 all the way up to $10. That wide range tells you that even the professionals can't agree on where this stock is headed. Some see the potential for a lucrative buyout at $7 or higher, while others worry about the challenges facing traditional broadcasting and the company's debt load. So what should you take away from all of this? E.W. Scripps represents a complex investment opportunity with several factors pulling in different directions. On one hand, you have a stock trading well below $5 with a concrete takeover offer on the table at $7 per share. If that deal goes through, shareholders who buy today at around $4.30 could see gains of over 60%. That's a significant return in a relatively short period. On the other hand, there's genuine uncertainty here. Scripps management has adopted defensive measures and hasn't committed to accepting the offer. The deal would need regulatory approval, which isn't guaranteed. And if the acquisition falls through, the stock could potentially drift back toward those lower levels we saw earlier in the year, around $1.36. The broadcasting industry itself is facing long-term headwinds as consumer habits continue to shift toward digital and streaming platforms. While companies like Scripps are trying to adapt by expanding their digital operations and securing sports rights for their networks, The core business of operating local TV stations is undeniably under pressure. This isn't a growth industry in the traditional sense. Instead, these companies are fighting to maintain relevance and profitability in a media landscape that looks very different from what it did 20 or even 10 years ago. For investors, that means you need to think carefully about your time horizon and risk tolerance. If you believe consolidation in the broadcasting industry will continue and that Scripps will either be acquired or find other ways to unlock shareholder value, there could be an opportunity here. But if you're looking for a safe, stable investment, this probably isn't it. Before we wrap up, let me give you a few final thoughts to consider. First, always do your own research before investing in any stock, especially one as volatile and situation-dependent as this. Don't make decisions based solely on takeover speculation, because deals fall through all the time for various reasons. Second, understand that stocks trading under $5 often carry higher risk. They can be volatile, sometimes have lower trading volumes, which makes it harder to get in and out of positions, and they may be in that price range for legitimate business reasons. Third, if you do decide to invest in a stock like Scripps, make sure it's part of a diversified portfolio. Never put all your eggs in one basket, especially with a speculative play like this. The story of E.W. Scripps is still being written. Over the coming weeks and months, we'll see how the board responds to Sinclair's offer, whether other potential buyers emerge, and what regulators decide about consolidation in the broadcasting industry. It's a fascinating case study in corporate strategy, industry evolution, and the sometimes messy process of creative destruction in American business. Whether you invest in this stock or not, it's worth watching how this situation unfolds because it tells us something important about where traditional media is headed and what that means for workers, communities, and yes, investors who are trying to navigate these changes. If you found this breakdown helpful, please hit that like button and subscribe to the channel for more deep dives into interesting stocks and investment opportunities. Drop a comment below and let me know what you think about E.W. Scripps and whether you see opportunity or risk in this situation. And as always, remember that this video is for educational and informational purposes only, not financial advice. Make sure to consult with a qualified financial advisor before making any investment decisions. Thanks for watching, and I'll see you in the next one.